Hi, Jeff Massey here. The first quarter of 2023 is behind us. Markets started the year strong, only to drop significantly in early March amid banking industry struggles. But spring ushered in a new upward trend for markets, and the quarter ended with positive returns for investors. In the video clip you're about to see, Tom Siomades, AE Wealth Management's Chief Investment Officer, covers some of the events that moved markets in the first quarter.
Hello again, I'm Tom Siomades, the Chief Investment Officer here at AE Wealth Management. And let's take a few minutes to go over the first quarter of 2023. The first quarter started off really well. In fact, it was the best January for the S&P 500 in 4 years. We closed out last year with a Fed funds rate of 4.25%, and expectations were that the Fed might raise rates one more time before signaling it would pause. There was the additional expectation that we would actually see rate cuts by the second half of 2023. GDP for the fourth quarter came in at plus 2.7% year over year, and inflation has been coming down. This all primed the markets into believing that the Fed could engineer a soft landing while whipping inflation down towards the 2% target rate that the Fed would like to see. Sometimes what you want is not always aligned with reality on the ground. As I just described, the markets were up on a very specific set of expectations that inflation would continue to decline rapidly, the Fed was near pausing its rate increases, the economy would avoid a recession, and the Fed would engineer a soft landing, and job and wage growth would slow. That's a lot of needles to thread. First, inflation did not cooperate as the rate of decline slowed and began leveling off, signaling that inflation would be more stubborn than expected. We've been talking about this for months, and in my opinion, the decline in inflation from the peak last summer was directly correlated to the decline in gas prices from record highs last July. As gas prices declined, it cost less to produce and deliver goods, so naturally some of those savings were passed on and reduced inflation. That was the easy inflation. Other components of inflation remained in place or got worse. Higher labor costs due to worker shortages, supply chain hiccups, people getting used to paying more, and demand not slacking at all conspired to keep inflation elevated. The other factor that worked counter to the Fed pivot narrative was a robust labor market. The Fed wants to destroy demand. So how do you do that? You can cure high prices by making prices higher, or you can create an environment where businesses need to lay people off or at least stop hiring. This would in turn lower overall demand at current levels and force prices to come down. After all, people tend to spend less money when they're unemployed. These factors persisted, and the Fed continued to take a hawkish stance, which in essence said they would keep rates higher for longer until inflation was tamed. That threw the rate cut discussions out the window, and the Fed pause became the new rallying cry instead of a rate cut in the back half of 2023. With that change in the investment wind, we had a pretty rocky February and gave back some of the January gains as we limped into March. March started out much the same as February ended, with markets still nursing their wounds after being disabused of their narrative by the Fed. But just as we started to regain equilibrium, Silicon Valley Bank collapsed. The news hit the markets hard. We were already in a delicate place, and a banking or liquidity crisis was not something the markets wanted to or needed to deal with. As of this recording, the regulators have since stepped in and made all SVB depositors whole. It also appears that the cap limits on the $250,000 FDIC insurance are waived, so troubled banks can once more count on the Fed to bail them out. The dialogue went from higher for longer to a discussion that based on this mini banking crisis, the Fed should immediately pause. In any case, the first quarter provided further proof that we're not out of the woods and not any closer to any clarity on when this bear market ends. I'll be back with you in 3 months so we can recap the second quarter of 2023. But we need to see some stabilization in the market and a clear direction. My concern continues to be the Fed overdoing it with interest rate hikes to the point where rather than pausing, it'll make things so bad that it'll have to reverse course because it broke something it cannot put back together quickly. And that'll force us into a recession. It appears breaking the housing market and almost breaking the banking system have not taught the Fed a lesson. What can be next? It's almost certain that there will be something new that we'll have to factor in. Until then, enjoy the spring and the warmer weather, and please reach out to your advisor if you have questions about how the recent events affected your portfolio or what steps you need to take to prepare for the next few months. Thank you.
Hope you found that information useful. If you have questions about recent market activity or your investments, call us at 401-333-8000. We're always here to walk you through what's happening in the market or what it might mean for your financial plan. Have a great day.